Hello, and welcome to this I think is our fourth class already, which is pretty amazing that we're here this quickly. So far so good on everything that you've done. Very pleased. Um, Really nothing else to talk about. Contact me if you need anything. I put something in the course chat, so if you want to talk a little bit more, and really my purpose there is I'd like to hear from you so that we could discuss things that you want to relate your career to vis-a-vis what we're studying. So if you have any thoughts on that, let me know and I can help you with that because this is all about not just learning, but getting transferable skills. And that's what we want to see here. So let me know. Let me know what you're doing if you want. Let me know where you're taking your career, how you would use these for, how you could see yourself using forecasting in your daily routine or in your future aspiration in terms of what you're doing, and I can absolutely help you with that. And I can intersperse that because we're going to have a couple of discussions coming up on week 5 and week 6. So we could talk about that during the discussion period, or we could talk about it right in the course chat. Either way. And if you need anything else, obviously you have my email. You know where I am. Just contact me, and we can get that going. So let me share my screen. And let's get to our class. So this is right, you know where this is. This is the interactive tool. And today we're going to talk about bond and equity valuations. Staring this way because I have a bigger screen here, so I don't want you to be, not to be disconcerting. All right. So what's a bond? A bond is basically, at its core, a tradable loan. So think about bonds as a tradable loan where a company borrows money or the government, and what it is the just want to clear up some of these going on here. That's the derivation of the Black-Scholes equation, by the way. We did this last week, if you recall. Just doing a little like pickup work on that. So a bond looks like something like this in the old school. I'm gonna pull up a corporate bond. So pull up a corporate bond. Um, and it's going to look something like this. So this is the way bonds did look back in the day. And basically this would be it's a municipal bond. It's a railway. It was, there are municipal bonds, corporate bonds, and government bonds. Municipals are issued by municipalities, cities, states. Corporates are issued by corporations, and the government issues government bonds. But this would be a municipal bond, actually. And notice you have the principal part, which is every bond's trading $1,000 denomination. So even if you bought $1 million, or you loaned $1 million to somebody, you would get you'd get $1 million of these of these certificates divided by 1,000, right? So that would be 1,000 of these. And then if you notice at the bottom, they have these little coupons because every time the bond pays interest, you would have remitted the coupon and received the coupon. So like if the bond, and bonds generally pay twice a year. So say this $1,000 bond, it was a 5% bond and they were paying you 5%. You multiply 1,000 by 5%, which would be 50, and every 6 months you'd pick up $25. But today, obviously, it's a lot more sophisticated. Everything's done, somewhere in the bowels of Wall Street or in the SIAC, as it's called, the security industry. It's down in Lower Manhattan, and if you ever get in the area, there's some fascinating stuff to see in Lower Manhattan. And it's a great place to even just spend part of your vacation if you visit New York. There are these bonds probably exist somewhere physically, but everything is done by computer, and your interest is given to you by computer. And if you sell it, it comes out by computer. So just so you know, by way of information, and it's an interesting area if you ever get a chance. It really is. This is the SIAC building in Lower Manhattan, and this is where a lot of This stuff is, I guess some of this is sports related, some other site. But this is where a lot of the computers and all the stuff that happens in the bond markets and in the stock markets, all of the accounts are kind of taken care of through SIA. So, you know, everything is, see if I can do that. Everything is done by a computer nowadays. There we go. So that's what it looks like. Okay. Again, I don't know. This is some sort of sports thing. I don't mean to be confusing. You know, if you ever get in there, and this is NASDAQ, it's kind of uptown, the NASDAQ building, and the stock exchange is downtown. Stock exchange is right downtown at the tip of Manhattan. Interesting thing if you get a chance, really. Very, very interesting. There's the front of the stock exchange. Spent many years there. So if you have any questions about it, feel free to ask. All right, so, you know, ask me by email. So what's the bond pricing formula? It's the coupon discounted back plus the bond price discounted back till today. So basically what we're doing is we have a paid rate on the coupon, whatever it is, 5%, say. The bond you get paid in at the end of the term, 5 years, 10 years, however long the bond goes. And we discount it back like to time value of money to see what the value of the bond is today. It's really a simple time value of money calculation. So we have the coupon divided by 1 minus 1 plus the risk-free rate, the rate that we're using, the discount rate, I'm sorry, raised to the negative power to maturity. A lot of this stuff is going to be done through the magic of computers, or actually Bloomberg has really revolutionized the bond market. And that's how that's how Bloomberg became so popular, was because he basically invented a program or a computer that you have a lot of these bonds and you can slice and dice them and understand the values at any point in time. So the Bloomberg system has really revolutionized how bond traders look at the bond market. So to look at a Bloomberg bond screen, you'll see that if you called up a particular bond, first of all, that was one of the big things with Bloomberg. You could pick up just about any bonds, and there's so many bonds outstanding. But when you pick the bond, it's the different markets, and then you get a bond like a General Motors, and it gives you all the information, and you can do an interactive look at the spreads and the yields. So all these calculations we're talking about is at a trader's fingertips. How much is outstanding, everything you need to know. And this was really the genius behind Bloomberg. It was really the bond market. I mean, they have news stories. This is all Bloomberg. If you get a chance, you know, and you have access to a machine somewhere, it's really a fascinating thing. If you want to work in the industry, certainly, it's something you would definitely want. That in Excel, you'd want to get certified for. So we could price a semi-annual bond using Excel. We will show you 3 approaches. The first approach is to sum the discounted cash flows. I guess, of course, Bloomberg is going to do all this for you. The second approach is to use the present value approach. So if we just take the number of periods to maturity, a 10-year bond, we take its face value and we use a 5% discount rate, and we have the coupon. So this is evidently a 6% bond, and we're going to discount it back at 5%. And you just put the inputs into Excel. And the solution would be, let me see if I can make this a little bigger for you. It's really not terribly difficult. Okay. You would put the periods up here, and then all you would do is solve for each cash flow, find and divide by the present value of the cash flows. And that would give you a bond price, that would give you cash flow, your bond price, and you would get your total value of the bond. Another way to do it, just by way of understanding it, is to just use the present value functions. I'm going to pull up a blank workbook, go to formula, go to financials, and you can go to present value. In this case, you're going to get this dialog box, but of course you would put your variables here, and you would use your discount rate would go up here, and always use a percentage sign. The number of periods would be here, the payment would be here. So let's say I just wanted to look at the coupon payment of $50. Make it pretty simple. And I want to discount it back by 6%. And I want to see what it looks like. I'm going to do an annual payment, not a semi-annual payment. Meaning, I'm only going to assume I get paid once a year. And I want to look what it would look like if I make 10 of those, what the present value of it would be. So if I have 10 years of annual payments at 6%, this at 5% discounted at 6%, what should it look like? So I'll go to Formula, Financial, Payment, and my rate's going to be 6%. I always put the percentage sign. Remember that, very important. To put the percentage sign in Excel. Put the number of periods there. The present value, it's going to be here. Wait a minute. That's the payment. I pulled up the wrong one. I'm sorry. Go back to Formula, Financial, and I pulled up payment. I was solving for payment. I have to solve for present value. Okay, so the rate is 6%. The number of periods is 10, and the payment is 50. And so that would be worth $368 today. Now, if you just multiply 50 by 10, you'd say, wow, it's worth 500. But if I discount it back through those years at 6%, it's going to equal $368. Now, let's say I have the bond part. Let's do it. Let's do the whole thing. So I have a bond that was going to pay me $1,000 at the end of the 10 years, right? But I'm going to discount that by 6%. Right? That will pay me back in 10 years, right? I get the last 1,000 at the end of year 10. So now I can just go back to Formula, go to recently used this time, go to present value, go to rate, go to number of periods, which is 10, go to payment, which is, oh no, go to future value, which is 1,000. This time you use future value. And there you go. I would just add these two together. So it always, I put in positive variables, so I get a negative, just so you know. I'm going to sum these by hitting the sum. And 926.40 would be my bond value today. Okay, that's it. That's all you need to do. Okay, so let's go back. And that would be the formula if you didn't have the magic of Excel. That's the coupon, 1 minus 1 plus the rate raised to the negative power of time over the discount rate plus par, which is what I did. Basically what I did is that. That was my first calculation. That was my second calculation. So you could follow along. Semi-annual bonds pay twice a year. So all I do is double my periods and divide my discount rate in two and divide my coupons in two. So that's what I need to do if I want to do a semi-annual. I have to double the payments, right? The payments get doubled twice, but the coupon gets divided by 2 and the discount rate gets divided by 2. And that's how you do that. And you'll get a deeper discount because you've done it a number of times. Almost like when you compound going forward, you get a little extra interest because you do it twice a year. It works the same way on the way back. Okay. Now he actually paid 60 and 5%. I did the opposite. Let's try it if I do it their way. Let's do 60 and 5%. Should be close. Here's the issue. Let's just keep moving. So in this case, if you run these numbers, you're going to get a solution of 1124.62. That's 20 periods. Discount rate is 5%, 60. That'd be annual. That would be doing it on an annual basis. Okay, so that's 60. So what they're saying is you're getting the $60 every period. See if I can come close to that. Yeah. So by doing $60 over 20 periods at 5% discount, so you're getting a 6% bond that pays 60 every twice a year. So it's like a 12% payout. And you're discounting back by 5%, you're going to get 1124.62. Back here to our interactive spreadsheet. There's your answer. Same thing, 1124.62. So they did it longhand. I did it kind of shorthand, and I wouldn't mind you trying it both ways. But this way you could see how you can do it very easily. By finding the present value of the bond, the coupon piece, and then the present value of the corpus piece. That $1,000 is called the corpus piece. Or so going back 20 periods, you get a much deeper discount, obviously, but it's going to equal 1124. So what we're saying is $1,000 discounted back at 5% over 20 years is going to equal $376.89 today. The 20 coupons that are paid each period over the 20 years, discounted at 5%, which started out at 60, is going to be worth $747. Now, if I multiply 60 times 20, I'm going to get 1,200, but I'm discounting it. Now notice if I raise the discount rate, what do we expect to happen? The bond value goes down. So I'm discounting by a bigger number. And I just want to explain something for a minute. What happens if I lower the discount rate? What do you expect? You should expect the bond value to go up because the bond prices don't change. What happens is the market reacts to the current yield. So that's why when rates go down, bond values go up. And when rates go up, bond values go down, because when rates go up, you own a bond. Let's say you own this bond. This was a bond that paid 66%, right? $60 on $1,000, 6%. If all the current rates that are comparable to that bond go up to say 8 or 10%, people are getting 8 to 10%. You're only getting 60. And if you want to sell it, you have to kind of compensate the buyer. How do you do that? You adjust the value of the bond. So let's say you're holding this 6% bond and the current rate's at 10%, and you want to sell that bond that you bought for 1,000, you're only going to get 659 for it. But, and the Fed has been lowering rates, right? If rates go down to say 3%, well, you're holding a bond that pays 6%, everyone's getting 3, you're going to get a premium. And that's how you compensate the buyer. So that's how the bond market works. Yields go up, your bond prices go down. Yields go down, your bond prices go up. Okay? And of course, if you want more on this, go to my YouTube channel. So you got the bond. This is just going over what I just did, going over the bond variables. And then they just give you another example. And you could do this one at home. Assume a bond maturing at 10 years with a coupon rate of 8%. Par value is 1,000. Investors are requiring 8%. The price of the bond is that. And what they're doing is they're doing it the way I did it. They say the number of periods, use NPR, solve for the number of periods, face value, use future value, discount rate, use that, coupon payment, use that. They're just doing what I did. So why don't you take that idea of what I did here and try it at home. See if you come up with the same number. And all you would need to do, get that, is plug in 8%, or I plugged in up here. Well, what you're really going to want to do is take 1,000 and multiply by 8%, And the coupon would be 80 in this case. Okay, coupon would be 80. Okay. And then what did they discount it by? Discount rate is 10%. So put it there. Always the percent sign. Remember that. Always the percent sign. Then what's the periods? The number of periods is 10 this time. We know every bond is $1,000. And notice they got 877.11. What did we get? 877.11. So even though I did it for you, feel free to try it at home. Feel free to try it at home. You know, a couple of things while I'm on this spreadsheet, we don't have to make it so kind of stark. Make it pretty. You can always make your spreadsheets prettier. So I want to make a little chance for me to teach you something. You can always make it prettier. Call this. Let's widen that. You can do, you know, what's the magic of using? You can call this the coupon. Call that the coupon. Those little coupons we talk about, which you get paid every year. We can call this the discount rate. You can call that the number of periods. I'll call it NPER. Call that the face value. Make it pretty by and some colors in it. Ain't nothing wrong with making it pretty. I always like to do that. Here would be your answers, your outputs. Now notice when I did the outputs, if I put positives on one side, but I get negatives on the other. If I made these negatives, these would come out as positives. And we'll call this the bond price today. That's all I did. Any questions on this? We would make this, highlight it. So you can do a lot of fancy stuff if you want to have fun with this. And I made a little bond calculator. That's all I did here. Made a little bond calculator. You can play around with different color schemes. You can do different fonts. I kind of like that font. Just for fun. You could do a little effects. So you could do a lot of fancy with this. I'll have some fun with it. Okay. Do themes. But you know, like anything else, just keep playing with it. Do different themes. You won't find one that you like. I like this one. I don't know. There you go. Let's try another theme. It'll use different fonts. It's like, I guess, like, you know, they've color coordinated a bunch of different themes. Let's see if you like it. A nice one. And there you go. Just a little extra today on how to play around with it. And you got to play with it like anything else. Okay, let's keep moving. Lastly, equity valuation. In this section, we discuss common and preferred stocks. And basically, the common stock valuation is the price of the stock plus the dividend over the required rate of return. That's the old school way of doing it. We just basically assume it pays a dividend, and if it doesn't, you have to assume a dividend, and we discount the dividend back by the price. Now, one of the very popular video I should show you now, if you go to my YouTube channel, which I've included the link, go to my channel, go to my playlists, go to Finance Academy. I got a lot of stuff here. And this one that comes right up because it's been the most used, I guess, is my equity value models. It's all 7 equity value models. There's also here time value of money units using Excel. I mean, we got a lot of stuff here. How to do bond valuations, how to find corporate yields, all the stuff I'm doing today. Even a whole tour through the financial statements. It's a lot of stuff here that we'll keep referring back to. Okay, so I'm not going to spend time, but you should spend time going through it because that's what it's there for. It's there to help you, and it's totally free and open up to you, and it's my pleasure to give it to you. So you take the stock price equals the present value of future dividends over the present value of the future selling price. So a stock is priced today at 80. The firm will pay $2 a share. The rate of return is 15%. So 80 plus the $2 dividend at the end of the year over 1.15. Basically, you're just discounting the stock price plus the dividend over the 1 plus the discount rate. And so what I'm saying is, if I pay $71.30 today at 15% return, I'm going to get 82 in a year. And that's gives me a value, gives me a present. All I'm doing is discounting back my present value. So what I'm saying is 80. Let's go back. 2. 15%. You can either write 15% or 0.15. Let's make that bigger. So in a year, I'm going to get this plus my dividend, put brackets around that, divided by, and it's up here too, you can do it, divided by 1 plus that. It's something. What's that? To put brackets around everything. See if that works. So let's do this. Let's do it this way. Let's make it cleaner. So we're going to add up our stock price plus our dividend that we expect. Bear with me. We're going to add this plus that. That's our value. Is that coming up as percent? Let me clear the contents. Okay, so we're going to add this plus that, and that's our value. Okay. Call that TV for total value. We expect in a year. And we're going to have 0.15 as our discount rate. Call that DR. Bigger, so we'll make it pretty. Don't forget when you're making presentations in front of your boss or your investors, try to make it neat. I'm going to clear that out. So now all I have to do is divide this. Let's see if this works this time. By 1 plus this. And there's your answer, 71.31. Now we made a little stock calculator. That's expected price, and we'll call it expected return 1 year. This is expected dividend. Okay, and we made a little stock calculator. I would ask you as a grade, well, you got enough, you have the exercises that we give you in school, you know, that Rasmussen gives you. But if you want to go to the next step and you want to do more with this, you wanted to try it, just recreate this and you have your own little stock calculator. Okay. There's your value. A little too dark for my taste. That's because it doesn't show up. I think I gotta go with a little bit of a lighter blue. Blue's my favorite color, by the way. I love royal blue. When I was a child, I had a great, like a Schwinn bicycle. I'm 62. It came in royal blue. Oh, I love that bike. I love that color. It's my favorite. See if I can find it for you guys. Here's what it looked like. Let's see if it's, yeah, here it is. I wonder what happened to that bike. This is what it looked like. It's great. It's a great bike. I loved it. Later on, I got like a, the regular bikes, the 10 speeds. But I love this bike. They made a beautiful bike. Everybody had them. They were in different colors. They were really nice bikes. I could still remember. So that was my bike, basically. That was it. It was not basically. That was my bike. Wow. Amazing stuff, right? I should buy them today. Look at that. I should have saved it. $999. Wow. That's something. Okay. Let's go back. Love that bike. Okay. So, and that's the expected return. It's your capital gain yield and your dividend yield. Capital gain is what you made on the stock. Dividend is what you get on the dividend, but you have to discount it back to today. Assume a stock with a share price of $22.30. If the firm is expected to pay a dividend of 75 cents in the coming year, the stock price is expected to grow to 23 by the end of the year. What is the dividend yield or the capital gain yield? And you're just going to reverse that. You're going to take the 75 cents divided by 22.30. You're going to get 3.36%. And then you're going to take your future price minus your current price divided by your current price. You're going to get your capital gain yield. That's all you did here. We said that we have we're going to have 75 cents. So 75 cents divided by today's price is your dividend yield. And if you assume that you're going to make 23 on it, and then that's what you earned, that yield. Now, this is an assumption, but this you can kind of figure on your own. So let's take a look. Let's go to Yahoo Finance. Let's pick a stock. We'll pick Apple. Yahoo Finance. Yahoo Finance is really good, by the way. You get so much information. So let's look at Apple. And if I call up Apple, there's the stock, there's the price, and it pays a dividend of 82 cents, and right next to it is the dividend yield, 0.61%. Now, if I assume Apple's going to go to 160 in a year, then all I need to do is take 160 minus 134.43 divided by 134.43, and I get my stock yield. That's the market cap, $2.257 trillion company, one of the largest companies in the world. There's so I would urge you again to spend a little time. It's down today. This is Yahoo Finance is terrific. There's your crude oil price. There's your gold price. Go up here on this ribbon. There's the euro dollar. There's the 10-year bond. A lot of good information here. Make it available to yourself. A lot of good information. Really, really, really good stuff. And you could do this in Excel. I'm not going to do it for you. This is pretty simple stuff. Do it. Definitely take time and do it. What happens if I got constant growth in my dividend? Well, I use the Gordon growth model, which is really a fancy term for, and I go over that in my video, right? All I have to do at that point then is take the dividend and divide it by the required rate of return minus the growth. By minusing the growth assumption, I'm lowering my required rate of return, and I'm accounting for the fact that it's going to keep growing. By lowering my discount rate, I'm going to get a higher value. But if I'm assuming that it keeps growing, I should get a higher value, which is what I'm basically doing. Once again, I take my dividend. Now, if the stock doesn't pay a dividend, we have to assume some sort of, what happens if the stock doesn't pay a dividend? Does that mean we can't use the Gordon growth model? No. It means that we would have to assume what the retained earnings would look like, and it makes some sort of dividend assumption. We'll look at other companies that are like this company. That's how you would solve for that. But here we take the dividend and we take the required rate of return minus our growth projection. So if it pays $1.50 at 6%, and our cost of capital is 11%, I just subtract out. Get that. And let's just do it, $1.50. Now, if I didn't have growth, right, I would just use 0.11. In which case, see now my spreadsheet has that same theme. In which case, I have that divided by that. I got 13.6. But what's my value as per my example? $30, right? Because I'm going to take my growth rate, because now I'm growing, which is 6%. Okay, so I'm going to say 11 minus 6. And we know math is going to tell us, through math, that now I can discount by a lower rate because I'm assuming growth. If I take that, divided by that, I'm going to get a much higher number, 30. I'm going to raise my valuation from 1360 to 30 because I have a higher growth rate. Again, kind of interesting, right? Could utilize, if you create this, it's a good way to follow what I'm doing. Actually, what I'm going to do is file, save it, browse, go to documents, go to Rasmussen, save this for you guys. Call this module for spreadsheet. Best reflection. I'm going to call it profess. So if you want it, it's available to you. I'm going to put it right in the, when this class is over, I'll add it into the Blackboard. Okay, let's keep moving. Okay. Non-constant growth model, then I would just assume the current stock pays dividend of $5.90. Firm expects growth over the next 5 years. The firm's cost of equity is 12%. What's the stock price? You use a two-phase. In a growth phase, you forecast the dividend over the 5-year period. In a constant growth phase, we forecast the firm's dividend rate to infinity. We then discount it back. So how do we do a two-phase model? We forecast the dividend over the 5-year period, and then we turn it into constant growth. Then we discount everything. So what we did here is, and I'm not going to, it's more extensive, we did the growth phase, and then we did it continuously. That's all we did. So going back to what this was, we have a stock that pays a dividend of $5.90 a year. The firm expects the growth over the next 5 years is outlined below. They expect 12%, 11%, 10, 9, and 8. And then they're going to have constant growth through infinity at 7%. So they're going to do a graduated growth, and I go over this in my video, and then you have the constant growth. So what they did was they constructed a spreadsheet, which is 12, 11, 10. Those are your growth over the 5 years. Notice they took that dividend and grew it, added it, came up with a value, and then did that value on a continuous basis. That's how they came up with 143.80. That's your 143.80 here. It's the sum of C17 through G17. So it was your growth in the first year, and we found the dividend plus the continuous value. We discounted it back by a discount rate. We discounted the second year by the discount rate. We discounted the third year by the discount rate. Okay. Notice it's the same number. Discounted back by cost of equity. Then we found our final value, which is continuous growth phase, which is here. And now we did it by continuous growth. Last year. It's the fifth year plus, which equals 212 now. Then we divided by the discount rate. We get 120. Once we start in year 5 and we added these up, we got 143. So this is a little more sophisticated model, but not very much different. ABC and preferreds are perpetuities, and perpetuities go on forever. So if I have a preferred that pays $4 and the required rate is 10%, all I need to do is very simple, is divide 4 by 10%, and I'm going to get a value of 40, which means basically I'm getting the $4 dividend every year. I'm getting a 10% rate of return. So whenever I'm dealing with a perpetuity, which means it goes on forever, I just divide the coupon by the required rate of return. And if I'll pay 40 because I know I want 10% every year, and I'm going to receive that $4 every year. Many methods. No single method is best for every situation. We showed you the most popular here. Next, we're going to get into the capital asset pricing model. Okay, so that's it for today. Any questions, you know where to find me. The key word for this week is April. The key word is April. The key word is April. Okay, thank you for attending, and any other questions, please contact me. Thank you.